I will leave some of the topic related to how to build a research agenda, how to improve your teaching, particularly in COVID, to my esteemed co-panelists. But let me kind of share with you my agenda on robo-advisors, and you'll see that right now the agenda started trying to understand how effective are robo-advisors for investment decisions, but more increasingly you can see that, and I'll show you that there are applications of robo-advisors, for example, in helping people making better consumption decisions, better lending decisions. So I truly think that this area of research is going to explode in the next 5 to 10 years, exactly because we have so much automation that is becoming available to various companies, and so we have more and more implementation of automated advice, and so there is a very rich area of research as far as I'm concerned. Now I'm going to talk for approximately 25 minutes, and but you know, like I always massively over prepare in terms of the number of slides I have, so I don't think I'll be able to cover them all, but we're going to be getting to through as much material as I can. So the plan of the talk is going to be, first I'm going to try to introduce you to robo-advisors, why I think they're truly important, what are the main features of robo-advisors, and then I'm going to give you a little bit of a taxonomy of robo-advisors as me and my co-authors think about them. Then I'm going to show you 2 cases of robo-advisors for investment decisions. One is going to be for short-term trading, and one is going to be for long-term investment and portfolio allocation retirement. And I think this is going to be giving you a clear understanding that it is not totally clear that these tools can work in practice, and this tool can have or will be very it will be profitable, or they will be kind of very useful going forward. I see some questions in the chat. I don't know. Oh, Alberto, my screen is showing a black screen. Can everybody see?
I can't see it either. I was trying to.
Oh, okay. Let me see then. I see, because it says I'm going to stop sharing and I'm going to start sharing again.
Yeah.
Can you see my screen?
Yes, now. I thought that I warned you, but I was muted, so you...
Okay.
Yeah, okay. Now
so you didn't miss much anyway. So basically, I was just going through the plan of the talk. So the second part is going to be more about the robo-advisors for investment decisions. And then I'm going to give you some sense of the work that I am doing with some of my co-authors and some other people are doing in the area of robo-advisors for consumption and lending decisions. And then I'm going to leave you with some open questions in robo-advising. And in case I'm not managed to go through the whole talk, I'm just going to jump to that point. Now, if you want to look at some of the material that is going to be related to today's talk, you can go, and I think a very good introduction if you're interested in getting to know a little bit more about the topic is a chapter that I've written with Francesco D'Acunto titled Robo-advising. Then the papers on robo-advising for financial decisions are going to be the top 3. So the promises and pitfalls of robo-advising, who benefits from robo-advising, evidence from machine learning, and the needs and wants in financial advice, human versus robo-advising. And then the robo-advisors for consumption and saving decisions are going to be, and lending decision are going to be the last 3. So one is going to be crowdsourcing peer information to change spending behavior. There is an app for that, goal setting and saving in the fintech era. And then finally is a current working progress of mine that is called How Costly Are Cultural Advisors, Evidence from Fintech. And here, basically, we exploit the introduction of a robo-advisor for lending decisions for those people that are on peer-to-peer lending platforms. Now, why do we think that individuals need financial advisors and robo-advisors? Well, we know that most of investors are not financially savvy. And we know that potentially traditional financial advisor could help, but there are many problems with them. We know that they're generally very expensive. They have been shown to be rather ineffective. And also they cannot target the whole population. They tend to target only wealthy individuals because individual financial advisors, for example, have a limited amount of time they can dedicate to their clients. The only people they can cater to are going to be the ones that are going to be wealthy because they're going to be able to extract larger fees. And so they're going to be able to make a living out of it. Now, because of these problems, we know that there is a huge scope for increasing the effectiveness of financial advice, and in particular, increasing the number of people that receive financial advice. And I think that this is where robo-advising can come into play. But let me first kind of define what robo-advising really is. And I think that robo-advising is any sort of advice that is generated by a computer algorithm that is tailored to clients' characteristics. And I think one aspect that people tend to generally not consider, but I think is absolutely crucial, is the ease of implementation. So in many cases, most of these robo-advisors are going to have the key peculiarity that they're going to have automatic execution. So they automatically are going to execute the advice, and at the same time, they're going to provide some sort of financial education. And I think this is actually crucial because there is a lot of evidence in the literature showing that even if you give very good financial advice to individuals, they tend not to follow it. So Bhattacharya has a very interesting paper on this topic where he writes, you can lead a horse to the water, but you can't make it drink. And I think the really interesting aspect about it is that what they did in that paper, they tried to give very good financial advice. They told people exactly what to buy and how to buy in terms of the securities to hold in their portfolios. But the truth is that people were simply disregarding this advice. Now, the way I really think about robo-advising is kind of a middle ground between the no intervention and nudges. You know, Richard Taylor and co-authors have been very popular for their idea of nudges and the kind of default options. What if we think about robo-advising is the next step, is a step where we're going to be able to provide tailored advice to individuals automatically that is going to be tailored to their individual characteristics. Now, what are the main advantages of Robo-advisor? Well, they can offer financial advice at very low fees. They can serve individuals with any level of wealth. They can be monitored and improved over time. So one crucial aspect about them is that in many cases, they rely on algorithms. So these algorithms can be reviewed and can be improved over time. And this cannot really be done with human advisors, for example. And their decisions in many cases can be explained to investors and regulators. And that's why also in many like algorithms that are based on machine learning, a big area of research is that of explainability of AI, exactly because there is a need to explain to investors and regulators why a certain algorithm, a certain machine made a certain decision for certain investors. Now, what are the disadvantages? Well, many individuals may not want them, right? They may not trust their advice, and many algorithms simply may not work very well. And before getting into the cases, let me just give you a sense of how I think, and me and my co-author think about robo-advisors. So in general, you can classify robo-advisor along 4 major dimensions. One is the personalization of the advice. If you think about it in terms of the investment decisions, a very primitive form of robo-advice would be that of target date funds. Target date funds are simply funds that adjust the portfolio allocation for the individual as the individual ages. But the crucial thing about it is that it doesn't matter what your characteristics are, what your risk aversion are. What really matters is only your age. So you can really think of target date funds as a very primitive form of robo-advising that is where the financial advice is based only on your age. Then another crucial aspect is how much involvement the individual has. On the one hand, we have robo-advisors that simply give advice to the individuals, and then the individual can implement the advice maybe in a simple fashion, but the individual always have discretion. On the other hand, at the other extreme, there are what we call robo-managers. Robo-managers instead take control of the portfolio and completely take care of all the transactions and financial decisions, excluding the individual. The third, I think, is the discretion, investors' discretion deviate from the automated advice. And this is kind of related to the second point. Some robo-advisors will allow individuals to deviate and maybe accept only part of the advice, and some other instead are going to be all in or all out kind of structure. And then I think that the fourth important one is going to be the presence of human interaction. So in many cases, in particular for individuals that are algorithmic averse, it's going to be very hard for individuals to follow the financial advice of a pure robo-advisor. And so there is a kind of a thriving literature trying to understand how much human interaction do you need in order to complement the decisions or the suggestions of the algorithm. Now, if you look at the asset management space, this area, at least in the private sector, is absolutely exploding. So you had that a lot of firms that you see here that are doing robo-advisors or B2B robo-advice or robo-retirement or portfolio management or digital brokerage were simply not in existence 5 years ago or 6 years ago. And now instead you have a huge explosion of all these potential services that could be or could not be useful to the individuals. In many cases, the devil is always in the details, right? So depending on how these are going to be structured, you may have that they're going to be potentially useful or potentially detrimental. Now, just to give you a sense of what I mean by this, I'm going to show you 2 cases. First is going to be a robo-advisor of an anonymous Indian brokerage firm, and the second one is going to be Vanguard's robo-advisor. The name of it is Personal Advisor Services. You'll see that they have completely different approaches in terms of providing financial advice, and you'll see that some of them are going to be more successful than others. Okay, so let me kind of show you this, the results from this paper. It's called The Promises and Pitfalls of Robo-Advising. So the setting is a large-scale study of the effects of robo-advising on investment decisions. And we worked with a full-service brokerage house in India. And the robo-advising tools, it's effectively what you can also find online as an automated portfolio optimizer. So here we have access to a very rich data set in terms of investor characteristics. We have their demographic characteristics, their portfolio holdings, the full set of trades, and the portfolio optimizer usage. And the questions we answer here are very simple. We say, okay, first of all, does robo-advising, does the effect of robo-advising are common or across or uniform across all users, or is there a lot of heterogeneity? And we study the effect of robo-advising on diversification, portfolio volatility, portfolio returns. And we also trying to study how much using robo-advisors changes individuals' behavioral biases. So the disposition effect, the rank effect, and trend chases. So before giving you kind of the main results, let me just give you a sense of how this portfolio visualizer works. This is very similar to a portfolio visualizer of Silicon Cloud technology. The main characteristics, and some of them are really undesirable, is that it does mean variance portfolio optimization following Markowitz. It has a very limited number of years used to compute the variance covariance matrix. What it does is that it uses the current stocks of the individuals and it suggests additional stocks up to 15. It imposes short sales constraints and uses shrinkages simply because they do not want to have crazy weights for the individuals. And all the suggested trades can be executed in batch mode. So as researchers, what we had access to is the individual investor's position and all the trades, and also the timestamp of the usage by these investors. And we see the portfolio weights before the usage and after usage of the robo-advisor. And this is kind of a very simple screenshot of how the optimizer works. As an individual, you would go in, suppose you have 10 or 12 or 15 stocks. What he would do is would re-optimize your portfolio allocation, would tell you what the efficient frontier would be, and it would basically give you a suggestion for what would be the optimal portfolio allocation and the additional stocks to add. And if you notice here, I have this little button that says optimize now. If the individual were to push that button, automatically the portfolio allocation would be remanipulated for it. Okay, so what we have is, of course, a huge number of results in the paper, but let me focus on the key baseline results just to give you a sense of what are the main findings. What we do is we compare the portfolio level outcomes before and after the usage of the robo-advisor. We use a 1-month window, and we account for all the time invariant investor characteristics that might determine adoption. What we find is that depending on the characteristics of the individuals, you have that the portfolio, the robo-advising advice, in some cases useful, but in many cases not. So robo-advisors increases diversification and performance for those people that were clearly under-diversified, but we also find a lot of pitfalls. Those investors that had a lot of stocks already actually end up not having that much gains in terms of diversification, and in fact, they start engage in excessive trading. So they start paying too much money in fees. Just to give you a sense of graphically what the results are, this is the change, the average change in the number of stocks as a function of how many stocks the individuals had before. And so what you see is that there is a clear, very kind of a nice monotonic declining relationship. Those individuals that had very few stocks before using the Robo-advice effectively increase the number of stocks they have. Those instead that already maybe had 30, 40, or 50 individual stocks instead end up reducing the number of stocks they hold in their portfolio. When it comes to risk or volatility, this is kind of always market adjusted risk. We have that the risk of the portfolio is actually decreased across all the investors. But you don't see that big of an improvement in terms of performance. So once again, what you see is that there is very little improvement in performance. Only those individuals that were holding 1 to 2 stocks before using the Robo-advisor actually improving their performance. The other ones don't see a big improvement. In fact, they don't see an improvement in performance at all. And what you see instead is a big change in the number of fees that people are paying. Those individuals that had 10 to 50 stocks before starting to use the Robo-advice, they start training way more afterwards. And this leads to having an increase in the fees they end up paying. The second thing we go in and try to understand is what is the effect of a robo-advising on behavioral biases. And here we study the disposition effect, the rank effect, and the trend chasing. And I'm going to just show you the results for the disposition effect, just because it's the most studied bias, and I think it's probably the most interesting one. So for those of you that are not familiar with the disposition effect, is simply the propensity that individuals have to realize the gains, but not to realize the losses. So if you have a portfolio of 10 stocks, individuals are going to be much more likely to sell those that have appreciated over the previous 5 or 6 or 12 months, and instead they're going to hold on to the ones that have not increased, or in fact that they were at the losses. What do we find? Well, we find actually a 30% reduction in disposition effect. So this, to us, is nothing else that part of the fact that mechanically you're going to have that the robo-advisor is not going to have any sort of disposition effect, of course, but also the idea of teaching individuals in thinking in terms of portfolios, but not of individual trades, means that when they start trading by themselves after using the Robo-advisor, individuals, they are going to be much less subject to this idea of thinking about the individual stocks performance. They're going to start thinking more about the overall portfolio performance. When you think about trend chasing, you basically have pretty much the same results. So from this work, what we had is that the main conclusions is that these robo-advisors had a very different effect on the types of investors. For those investors that were really under-diversified, access to robo-advice increased diversification, increased investor attention to their portfolio, and increased also their performance. On the other hand, you had for those investors that were already diversified, you had that access to robo-advice had no change or a reduction in the stocks held by the individuals, and an increase in the number of trades and the fees paid, but not really in the performance. So one thing that is kind of unique about this study is that this was the first study that was done on any robo-advice. But the truth is that in particular in the US, robo-advisors are rather different from these individual portfolio optimizing tools. What in many cases, and this was kind of coming up a lot when we were presenting this work, most of the people were saying that the majority of these robo-advisors are based on index mutual funds or ETFs. They do not work with individual stocks, and they also have very different characteristics. They don't allow a lot of discretion to individuals when it comes to making decisions, and they also involve human components. So this is kind of what led to this second study on robo-advising that is titled "Who Benefits from Robo-advising? Evidence from Machine Learning." And the idea here was to try to understand what would be, or what are the effects of a very modern, sophisticated robo-advisor. So we study here Vanguard's PAS, which is the largest hybrid robo-advisor in the world. What I mean by robo-advisor is that individuals not only have access to a algorithm that effectively sets the portfolio allocation for the individuals, but they also have access to an individual financial advisor, so a human financial advisor that can help them making certain key decisions in terms of what plan they choose and how they choose it. The key differences between this and the Indian robo-advisor is that this robo-advisor is mainly for long-term portfolio allocation. It is based on mutual funds. Back then it was based on mutual funds, now it's going to be based on ETFs, and it allows very little consumer discretion. But let me just show you, just to give you a sense of how different it is, let me show you how this robo-advisor works. If you were to sign up for this robo-advisor, what you would do is you would be profiled on your characteristics. So you would be asked what are your financial objectives, what are your risk tolerance, your investment horizon, your demographic characteristics. And then you would have the algorithm would come up with a comprehensive financial plan for you. In particular, it would just generate cash flow forecast, and it would just kind of come up with a recommended portfolio strategy. At that time, your basically will be cut out of the system. You would need to wait to talk to a human. They would explain to you exactly what the plan does, what are the fees, what is the horizon, and what are the characteristics. And then if you decide to enroll in this kind of service, you do not have any control anymore regarding your portfolio allocation. So this robo-advisor will trade automatically. It will rebalance for you quarterly, and you effectively do not have control of what are the portfolio allocations. What are going to be the main findings we're going to find here? Well, we're actually going to find massive changes, much bigger changes compared to the other robo-advisor. In this case, what we'll find is that bond holdings are going to be increasing for individuals. You're going to have that cash is going to be basically drawn down to zero. You're going to have that the investment vehicles used for portfolio allocation are going to be changing. All the wealth is going to be in mutual funds and very little wealth instead in stocks and ETFs. You're going to have that indexation is going to increase. So wealth is going to be moved out of active mutual funds and into index funds. You're going to have a very big exposure of these individuals into international stocks. And effectively, you're going to find a big increase in risk-adjusted performance. And we're going to have that on average, people are going to be increase their performance by a lot. But of course, you're going to have some individuals that are going to be benefiting more and less. And the people that are going to be benefiting more were the ones that had little experience before signing up, the ones that were trading a lot, and the ones that had high cash holdings. And instead, the ones, and this is kind of not surprising, the people that instead had very little of the wealth in individual stocks, but had a lot of the wealth in index mutual funds, for example, actually will see their performance not increase by much. But just to give you a sense of how much and how strong and how kind of large the changes in portfolio allocations are, let me just show you a number of plots. So here I have the portfolio allocation of the investors across different months from -12 to 12. And then you have 0 is the time where the robo-advisor was implemented. And here I have the blue line is the average cash share, and the red dotted lines are the 95% confidence intervals for the mean. You'll see that this cash share is approximately 10%. Before the adoption of the robo-advisor, you have a little bit of consolidation, some selling, but afterwards, what you'll see is that the cash is basically drawn down to 0. In terms of percentage of the portfolio in mutual funds, you have that these individuals already, when they were self-directed, had a lot of the wealth in mutual funds, approximately 80%. But afterwards, this portfolio, the wealth in mutual funds goes all the way to 95%. And one thing that I want to show you is that one effect you're going to find in this kind of robo-advisors is this homogenization of the portfolio allocation across investors. And you can see here with the indexation. So 50% of the wealth of these individuals was in index funds before signing up. After signing up, it goes up to 80%. But what do you see here now? The red dotted line are the 10th and 90th percentile of the percentage of indexation across all the individuals. And you'll see is that what happens that before you had the dispersion was all over the place. Some individuals had all their wealth in index funds. Some people had 0. But afterwards, you actually have a huge compression in the dispersion across the 10th and the 90th percentile. The same is true for international exposure. One of the biggest problems that individuals have when it comes to their portfolio allocation is that they tend to be having a large home bias. So they are not international diversified. And instead, what you'll find here is that this robo-advisor basically over the course of a month exactly reverts all this under diversification to the international market. Management fees are going to be the same. You have a big reduction in them. Now, when it comes to performance, what we can do is effectively track the risk-adjusted performance of these individuals all the way from the 5 months before signing up all the way to 35 months afterwards. And what you see is that effectively right after the first month, you see an improvement in the performance. Where does this performance come from? Well, effectively, it's going to come, and I don't have time to go through all the details, but it's going to come from volatility. So you don't have that big of an increase in returns. In fact, you don't see any increase in returns, but you have a huge reduction in volatility. And this is why the realized Sharpe ratio is going to increase for these individuals. Now, one thing that is absolutely crucial to understand is that, okay, there may be some benefits in terms of portfolio allocation, but is there any benefit in terms of the attention that individuals have to spend looking to their portfolio allocation and studying what to do with their stocks? And we can study it because we have data on the attention of the individuals. We have their information regarding when they log in, what interactions they have with a human advisor. And what you actually will find is that if you look at the total days with logins within the month, you have a big spike. Oh, sorry, guys. You have a big spike on the month they sign up, but then over time, at the beginning, individuals tend to kind of monitor a little bit the robo-advisor, but after a while, they actually tend to decrease the number of times they log in into the platform simply because they don't need to acquire information on how to change their portfolio allocation because this tool does it for them. This is the total logins. I think what is interesting is that if you divide it into the attention via desktop computer and the attention via mobile phone, what you'll find is that while the attention via desktop computer goes down, the one through the mobile app actually stays higher, which basically just tells you that there is still some monitoring that is done informally by the individual through the app, but the individuals don't have to spend time thinking about what to do with their next portfolio allocations. And so they just quickly go and see how their wealth is evolving, but they don't do any financial decisions. And this is something that you see also if you go and measure attention by the number per minutes, the number of minutes per month. So if I don't focus on login, but I focus on the number of minutes per month, you'll actually see that it goes down either whether you're connecting through your desktop computer or through the mobile app. And now the last thing that I think is very interesting, I have way more results in the paper, but I just give you a kind of an intuition. We can study how important is the effect of humans' interactions in the retention to robo-advice, right? The crucial thing here is to understand whether this advice is effective is whether individuals have better portfolio allocation, but crucial is whether they stay with the service, right? Because even if the service can improve investors' portfolio allocations, but investors decide to quit, you actually will not have that much benefit for the overall wealth of individuals across all the individuals in society. And so one crucial aspect of that is that we actually have that depending on how wealthy individuals are, they will have very different levels of humans interactions. So this is the interaction that humans have across all groups of investors. So you see that you have some cyclicality, and this is because the human advisor reaches out to the individuals periodically to understand how whether they are liking the portfolio allocation they have and whether they need additional services. But this is the interaction between customers and their advisors depending on the level of wealth. So flagship are individuals that have more than $1.5 million in assets under management. Voyager between 500 and 1.5 million, and Voyager it's only, well, it's less than 500,000. What you see is that there is a very different level of human interaction. Well, the Voyager have almost zero interaction with the advisor or the human advisor after sign up. Instead, the other ones have more or less human interactions. And this actually shows up and turns out to be very important when it comes to explaining attrition. So if I show you the percentage of individuals that are still enrolled in the flagship segment, you have that after 4 years, approximately 90% of them are still with the service. And instead, the ones that the Voyager, the lower level, you see that only 75% are still in the system. So when you actually go and do much more of a sophisticated analysis, what you actually find is that the degree of human interaction has a huge impact on retention of these individuals. And so it begs to trying to understand what exactly are the characteristics that matter the most in order to make sure that individuals are helped by these robo-advising tools, but they also keep on staying with the tool in order to maximize their wealth at retirement. So the conclusions from research, this research is basically ETF-based robo-advisors can really improve portfolio allocations of already diversified investors. And effectively rather simple forms of robo-advice can be successful, but it is actually kind of hard to communicate advice or the value of advice to individuals that are robo-advised, and you actually observe significant attrition. Forms of hybrid robo-advice can be more expensive, but it can be very helpful in retaining customers. And we actually can document significant benefits that are unrelated to financial performance, but that are instead related to aspects that are non-purely portfolio allocation related. Now, I'm just going to have, given that it's 10:57, I'm going to have only 1 minute left. I don't have time to go into the details of the robo-advisor for consumption and savings, but one thing that is important is that you do not necessarily need to use robo-advisors only for portfolio allocation. There is now robo-advisors that are being used for consumption, savings, and lending decisions. Here, of course, it becomes a little bit less trivial to understand exactly what is optimal advice, but I have a couple of papers on here. The first one is effectively trying to assess the impact of an US aggregator that gives individuals information regarding peer spending. So if you were, for example, someone that has just graduated, you're an assistant professor in New York, what this will tell you is that how people that are making as much money as you, how much they're spending on their restaurants, on their shopping, on rent, and so on and so forth. And so in many cases, this provides a benchmark for individuals when it comes to deciding their investment decisions. This second project instead is an Italian app that effectively automatically helps people set specific goals when it comes to savings, and after setting the goals, help people achieve these saving goals. And then this Indian app instead is the third project I have in this area. What it is that it targets peer-to-peer lending individuals. And on this platform, most of the time what people do is they decide of specific loans to make. But one of the results is that individuals tend to be rather under-diversified when it comes to their portfolio lending. So this company instead introduced a robo-advisor that effectively helps generate diversified lending portfolio. And so what we try to understand is the impact of this and how this helps individuals making better lending decisions. So, but I think that there is going to be a lot of many more projects that are going to be in this area. And I think there are many open questions that as a junior in the literature or a junior in the field, you can start thinking about. So for example, we're now thinking and trying to understand whether holistic robo-advisor is a realistic possibility. Is it possible to have robo-advisors that will help individuals make better decisions on the investment realm, on the saving, on the consumption, or maybe mortgage lending realm, all at the same time? Is it possible to devise robo-advisors that are going to be robust to algorithmic aversion? And I think more importantly also, will robo-advisors democratize investing? So Is it going to be possible for more individuals to have access to financial advice? And is this going to be very important in kind of reducing the wealth inequality that we are observing right now in society? And what are going to be the systemic implication of homogenizing investors' portfolio allocation through robo-advising? We know that ETF and index mutual fund already may be cast potential problems for systemic kind of risk, for example. But if you now start having the robo-advisors will put individuals into the same portfolio allocation, do you actually have that the financial crises are going to be, for example, are going to become even stronger and even more dramatic compared to what would happen before? So I'll just stop here, given that I'm out of time. But we will continue the conversation, I think, in the afternoon with the smaller group. But thank you so much for listening to me. I hope this was useful and insightful for you.